Hello and welcome back to the Retire While You Work podcast. My name is Carson Odom, a wealth advisor here at Adams Wealth Partners, joined by Myles, another wealth advisor, and our CEO and founder, David Adams. We thought for this week's podcast episode, we wrapped up our series about young adults and financial planning for young adults. And given just the amount of headlines and volatility that's come with the stock market over the past couple of weeks, especially, we thought it would be a good time just to share some thoughts about the market, economy, what we're seeing, conversations that we're having, and share a handful of charts, nothing too in depth. So, David, I think it's been a few weeks, so thanks for coming.
Absolutely. Yeah. I mean, everything's pretty calm out there. Nothing really to talk about, right?
Yeah, nothing going on. I personally always think of the scene from Finding Nemo whenever the tank is super dirty. Then they go, the tank is clean. And I'm like, the time changed. We've got sunnier days. It's 75 degrees outside. The stock market's down. The stock market's down. So that's kind of like where we're at, where everything spring days are getting longer, but we've had
that just proves that you have two little kids at home.
Yeah, I do. Finding Nemo's obviously on repeat. I thought everybody doesn't know that scene. That's not a common scene at the top.
I didn't know that scene.
It's been a couple years since I've seen that one.
But I do appreciate the reference. It was great.
For sure. No, it's been 2024, I think, was unique in the stock market in that it was kind of boring in that it just went up for the most part.
Which is a good kind of boring. I like that kind of boring.
I think you could argue that for 2023 also.
Yeah, that's exactly right. I mean, it went up for the most part. Obviously, 2022 was a harder year in that it was the first bear market we've had since COVID, and really longer drawn out bear market, the worst year since 2008.
I'd call that a normal, after 21 years of doing this, a normal bear market, like where the market kind of just slowly went down the whole year, was down over 20% or more. NASDAQ was down in the 30% range plus.
Yeah.
It was just like you're not as bad as 08, but a pretty normal, nasty bear market. Whereas 2020 during COVID, it was just like a flash crash, like down 30% in 30 days and then pop back. But yeah, I agree with that. And then 2023 and 2024 were just kind of worked its way up without a correction, which I know we normally see at least once during a year, the market's down north of 10% or so. And so it's kind of actually unusual to have a 2023 and 2024.
So I'll share a good slide. And for those that are watching via video, this illustrates since 1980, basically, no matter what the market does on a calendar year basis, that there's always going to be, not always, for the most part, there's going to be some sort of pullback. There's always a pullback to some degree, no matter if it's 3%. But on average, this chart shows that from top to bottom, the market is going to pull back to some degree. The average is 14%. So top to bottom, you're going to have a correction of 14%.
So in a year, what you're saying, like it's an average intra-year decline of 14%, even when the year finishes up 10% for the year, you still had at least one point during the year it was down 14%. So that's important because who knows what the market's going to end up doing this year. But as of yesterday and today, let's just say the market's down, 10% or something year to date. It could still finish up 20% and say we had a correction early in the year, or it could turn into, not go back up, whatever. So,
I mean, the highlight of this chart is 2020. And I know that's a special year and we're coming up on the 5-year anniversary here, which is wild, but the market was down 33%, and then it ended up like 20%. I mean, what a wild swing that year was.
Wild. I mean, I think maybe the wildest potentially ever. I'm not sure. And then because you look at 08 where it fell the most, down 50%, you can see that in 08. You can see the market also finished down like 40%. So, which, that was a true, the Great Recession. So yeah, 2020 was definitely an anomaly. But yeah, this is good. Just a friendly reminder to say, things are certainly chaotic right now. It's hard to take politics out of it, but taking your personal preference for political affiliation out of it, Trump's tariff policies and the way he's going about it is going to be chaotic. It's his style. We know that the market hates uncertainty. Things are very uncertain right now. So we're even seeing intraday trading where the market could be down 800 points and then finish down 100 or up 50 points, just even throughout the day. So I just think we're telling clients, just brace for that this year. And again, volatility doesn't mean market crash. Volatility can also mean market goes up, but it's just how it's going to be this year. And so it's important to know that. And we're not, we're not like, we're not market timers. We're not rushing people out of the market and making big trades that can hurt people, because history proves that that's a fool's game. However, we did just rebalance our portfolios. We put a lot of time talking to top advisors around the country, some of the bigger shops, the Goldman Sachs of the world, the BlackRocks, you name it, just getting their institutional approach. And we make tweaks, like, for example, going for more value type of dividend stocks in a year like this versus heavy growth in tech, because heavy growth in tech killed it the last couple of years. But, we think dividend stocks, in an administration like a Trump coming after big returns in tech and those kind of companies makes a lot of sense. Who knows if that'll be exactly right, but so far this year that's worked. Carson, is there a chart like on diversification? Because I know that, God, you got all the charts historically, and I'll let Carson go through this, or Myles. Historically, historically diversification has worked. What I was going to say is the last 10 or 15 years, it feels like it hasn't. It feels like if you just own the S&P 500, you got the best returns you could get, better than asset allocation diversification. However, I remind clients, 2000 to 2010, earlier part of my career, S&P essentially did nothing for 10 years, was flat, and diversification kicked the pants off of the S&P 500. So, at some point that's going to roll back. It has started to this year. It's too early to tell. So we still believe in asset allocation, diversification. And you want to go through this chart, one of y'all?
Yeah. Let's look at, this chart is showing a few different indices and how they performed year to date, the best of which, we've been light on international, and the US has outperformed international for the past 15 years, basically, for the most part. And Europe is having the best performance this year. It's up over 12.5%. The overall all country world index, excluding the US, so a big global diversified portfolio beyond the United States, is up 6.5%. Bonds are up over 1.5%. While you sit here and you have growth stocks that are down almost 10%. So this is the reason why, yes, growth stocks are fun in the years where everything's going up, but they also fall extremely hard whenever there's some sort of pullback. So this, again, it's not that one sector is best, it's that the entire market is worth investing in. There's going to be pros and cons to each one year over year. They're all going to have their time to shine, and it's impossible to pick when that time is going to be.
Yeah, I agree with that. And I think going back to the other chart too, showing the inch-year declines, it's like this, it can create opportunity in times like this also. If you've been sitting on cash and you've said, I'm waiting for a market pullback, now's your time to start. You don't have to do it all, but maybe you take 10, 15, 20% of what you were intending to get into the market and you start slowly working it in. Reserve some of that cash for if we do see the pullback continue, where you can continue to working it in by the dips. I know some people use the analogy where the stock market's the only store where when things go on sale, people actually run out of it, then run into it. And so for those that have been waiting, this is, it could go a little bit lower, it could go lower, but it's also an opportunity to be buying into.
Or when there's a market dip, like Myles could go buy some wireless earbuds. What do you call them?
Go back to 2009.
I'm working on all my money in the stock market. I'm buying the dip. So $15 headphones.
You actually have the wireless ones. You just like the old school. You like to be ironic. I get it.
Yep. That's right.
Just giving you a hard time. Yeah, that all makes sense. I agree. Like right now, our clients that have cash, it's easy to come to us and say, we're nervous to put money in the market. Things feel chaotic. And we get that. And we say, okay, well, let's put it in a money market or something. Let's get a return. And then let's have a process every time the market falls X%, let's dollar cost average it in every, 2 months, 3 months, 6 months, whatever, something they're comfortable with, make it a little bit more robotic, take the emotion out of it. And then generally speaking, you have a good chance of maybe buying in at different dips in the market, different points that can kind of help long-term. Doesn't always work out perfectly, but it is a better approach than just saying, I want to wait till things are better before I put my money in, which usually means you're buying when the market's high.
That's right. At the end of the day, I wanted to share this to essentially show for the past 15, 16, 17 years, there has always been a headline. There is every single year that goes by.
A bad headline. A bad headline.
Yes, you're exactly right. A bad headline. The media makes money off of bad headlines, and that's where the profits come from, on invoking fear. So there's always going to be something to be worried about when it comes to the stock market. We're at, we're at a point where Trump's making the headlines with how he's going to handle these tariffs. And now it's all the talks about a recession. Is a recession coming? Well, I can probably go back and probably every other month for the past 3 years, I could probably find a headline, this person thinks a recession's coming. Okay, if you just let those dictate your feelings and your investment decisions, then you're probably not going to be a very successful investor. You've got to learn how to take all these negative headlines that are going to constantly be in the media and not let them dictate how you're going to invest your money, because we're long-term investors. And even if you're retired and you're living off of your money, a portion of your investments are for longer term. And that's why you're not just 100% stocks. You've got a portion.
And more money is lost waiting on the next recession, meaning, hey, there's always going to be a recession at some point, but there's going to be a recession. So-and-so said there's going to be a recession. I want to pull my money and go to cash. And then let's say the market goes up 9% more before the recession happens. And then it falls 20%. And then you don't get back in at the right time. You get back in once it starts coming up. My point is, you missed the ride up before it fell. Your net effect a lot of times ends up being the same or worse by trying to time it. And you had to go through the anxiety and the stress of trying to figure it out, and versus just sitting tight. Now, sitting tight doesn't mean being lazy. And, as a firm, we're not lazy financial advisors by any means. We don't just set it and forget it. We set it, an asset allocation for our clients, customized to their plan and to each bucket of money that they have, whether it's long-term retirement, shorter term, that sort of thing. Then we build an asset allocation strategically in the firm based on what we're seeing from all the big institutional data. And then we tweak that several times throughout the year. And then we also adjust when a client says, hey, I'm going to need cash in the next 6 months. We'll make a customized tweak in their portfolio in addition to the broad portfolios. So doing all those things helps dampen some of the volatility and keeps them on track. Their goal may be, how do we get I'm making this up, a 7 to 8% return with the lowest amount of risk? And so us figuring out that math versus just saying, we just want a big return, which everybody wants. But if you have to take a 30% down year, and that's the year you're in retirement, or that's the year you sell your business and dump it in the market, that you're going to spend 5-6 years just trying to break even for that. So that's why we try to look at it. Anyway, I could talk all day about this.
But I think specifically trying to make big tweaks to a portfolio based off the tariff news is just a loser's game, because an announcement comes out in the morning, there's conversations that go on behind closed doors. A different announcement comes on in the afternoon. For example, it was going to be 50% tariffs on steel and autos, and by the afternoon they were off for the time being. So it's like, if you make a big transition in the morning and then by the afternoon the market's rebounded, you don't want to get caught up in the crosswinds of headlines.
Great point, Myles. And our clients so far, get that, and we haven't heard a lot of grumbling yet. But I anticipate if it gets worse, human nature is we will. And what we try to tell clients during that time, at the end of the day, it's their money. And so our job is to coach. And we have this type of dialogue with them that we're having on this podcast today, but a little bit more personal to their situation. Plus, we know our clients. I know them as people, as friends, and their emotional temperaments. And if they start to hit that uncle point where they're like, they're freaking out, what we'll suggest is, let's not go all cash. Maybe they're 70-30, 70% stock, 30% bond, and they're freaking out. Maybe the answer is just to go 50-50 for a little bit, just to let them feel like, and then that way, if they're wrong and if the market starts going back up, they still got some of the returns, and then maybe we can bump them back to 70-30. Or if the market goes down and they feel good that they at least did something and that they were heard and we made an adjustment. Now, our job is we don't want them to go too far out of that range band to where if they go 20% stock and the market rallies 30%, that may take them off their goal of 7 to 8% return or 10% return, whatever it is, because they missed a big, bull market. So it's a delicate balance. It's more about emotions. Well, I'd say it's half emotions, emotion management and investor psychology, and it's half us strategically allocating the portfolio. So.
Yeah, I always like saying it's emotions are real, emotions are valid, and you'd be wrong to ignore your emotions. It's more about being aware of your emotions with the stock market and knowing that your emotions don't dictate or make your financial decisions. We, like Myles, David, myself, we have emotions. Whenever we see the stock market going down, it makes us emotional. We sit here and we talk about it. We don't like it. Nobody likes to see money go down. Assets.
We're not robots.
Yeah, exactly.
We have feelings.
So, but with that, We talk about it, and we're not going to make a decision based off a headline on a certain given day. We know that the stock market has worked in the past. We believe that it's going to work over the future, and that this is not the end all be all, and that this time is not different. History doesn't repeat itself, but it often rhymes. We know that there's going to be more corrections. There's going to be more bear markets in the future, and it's up to us to be like-minded in how we think, and recommend to clients steps that they should take in order to make the right decisions based on their personal financial plan, and also gather our thoughts to give good advice to each and every client specifically based on their financial setting. So,
and during times like this, we're going to continue to do, we've got a webinar coming up. We're going to continue to do these podcasts. And send out emails if you're on our email list. So if you're not, you want to get on it, please let us know. We want to be there with you and for you during times like this. As long as I've done this and having money in the market myself, I feel these same emotions. I'm not numb to it. I've just learned how to, and Carson and Myles, they hear me, talk about these things sometimes about, I can sense what clients are experiencing because I'm an investor too, and I've been doing it for a long time. And it is real, but the difference is when you've done it for a long period of time and for hundreds of people and been through, 20 market cycles, whatever, you start, not to react and not to take actions on those feelings, but to process them with somebody who cares and knows you. And then you can make a lot of times it's no decision, but you feel heard and you at least feel more confident, or there is a small tweak that needs to be made. Maybe you were feeling that way because you only had $40,000 in your emergency fund, and having $100,000 in there would have made you feel a lot better and quit obsessing about your $1 million in the market or whatever it is. I mean, some of those tweaks really, really matter, and they seem like, very insignificant changes, but I've learned that those things are important. So we'll continue to do that and be a resource for all of you.
Talk it out.
Sometimes just getting the voices out of your head and having somebody else tell you, like, validate your feelings, but also say, hey, here's reality. Here's what we're doing to make adjustments, or here's what it would look like if the market was down a little bit more, can help to relieve those fears and make you feel a little bit better.
Mm-hmm. Yeah, that's good. Well, we obviously can't solve the problem of the stock market in a single episode, but you just needed like 5 more minutes.
Figure out.
But hopefully this is helpful. Again, just a handful of charts. We're actually doing a webinar here in a couple of weeks. We'd love for you to join us. The link should be on our website, or if you're on our email list, you should have gotten the link to that. We'll have a few more things we're going to talk through, and probably be a little bit more extended time talking through it. So we'd love to have you there. But if there's any questions that anyone has, feel free to reach out to myself, Myles, or David. We're here to help. But thanks again. Thanks for joining us on another episode of the Retire While You Work podcast.
Thank you.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.